All right, in today's episode, we are actually speaking to someone who really is a gold and silver mining stock legend, and that's David Garofalo. He actually was the guy in charge of the biggest merger, which happened when Newmont acquired Gold Corp. So, this is someone who has an incredible history. I believe it was something that sold for maybe 62 billion. I know it was the largest merger in the history of the gold and silver industry. And so this is someone like no other that knows the ins and outs of mining stocks. He is now the CEO of Gold Royalty Corp. Now we spoke, man, it must have been about maybe 9 months ago or so. So it's fantastic to have you back on. For everyone listening, this is a very special treat to talk to someone that's been so successful running and investing in gold and silver mining stocks. So make sure you hit the like button on this video. Looks like we're starting to maybe bust out of that price pattern for gold and silver. So give us your gold and silver price predictions in the comments right there down below. And I want to welcome you, David.
Hi, thanks for having me on again.
All right, cool. So do you think that we're close to the next leg up? I think it's been a frustrating go around. It seemed like every macro force seems to be in favor of gold and silver, but it wasn't budging. And now we're starting to get some movement. We even had Warren Buffett even talk about inflation, which when before I think he referred to people that talked about money printing causing inflation as kooks. So even he's coming around here. So it looks like we're starting to see some interesting fireworks.
Yeah, absolutely. In the last couple of weeks, we saw some headline numbers that were actually quite dramatic, over 4% inflation, which we hadn't seen in a long, long time. And I think that really brought into stark relief for people what's been happening over the last number of years, really going back to the credit crisis over a dozen years ago. It's been almost unremitting quantitative easing, low interest rates for a very long, sustained period of time, a lot of new fiat currency being introduced into the system on a global coordinated basis. And recently, I think what's kind of taken our lunch on the gold side has been cryptocurrency and some of the errors coming out of that now. I think people are realizing there really are no barriers to entry in the cryptocurrency game. Anybody can create a cryptocurrency and capture market share, but gold doesn't have that kind of competitive dynamic. And there's high barriers of entry into the gold business. In fact, there's a remarkable inelasticity of supply to price just because it's so hard to find gold, so hard to mine it, so capital intensive, operating cost intensive. It's not like anybody could just start up a gold mine tomorrow to meet what's now incentive pricing for new gold development and exploration.
So it's about May right now. It's May 17th, which, we were kind of either just get going of the last run up and approach to 2000 in gold and approach to silver to 30, or maybe a little bit into it, which kind of ended August, September. Ironically, we're starting to get this push right about this same time. People often won't take gold as seriously because they haven't believed in this idea that quantitative easing and money printing is really going to cause inflation. And as you said, there was a little bit of cold water at the 4%. We know that's low. I mean, you look at the gas station, you look at your food, it is everywhere. And do you think that people have to basically realize that this is starting to really happen? These actions and this monetary infinite stimulus is finally starting to catch up with our currencies?
Yeah, no, you're right. I think at the personal level, people are experiencing inflation far above 4%. If you're trying to buy a house today, you're experiencing massive inflation. You're having to enter into significant amounts of leveraging just to buy a home or maintain your home. So we are seeing evidence of inflation, and it's becoming much more personal. So I think people are starting to realize they need some sort of preserver of capital in that type of environment. And by and large, the new investors have been looking at cryptocurrencies as a way to do that because intrinsically they understand they need to preserve their capital. So they were casting about for something that would protect their capital, but they're realizing, given the volatility of that, again, the lack of barriers of entry, they're starting to come around to gold, which has been a currency for millennia, for 4,000 years, and given the small amount of gold available in the marketplace, volumetrically, it's tiny. It's 4 Olympic-sized swimming pools, about 200,000 metric tons. It's not a lot. And we're only adding about 4,000 metric tons a year to supply, and that's declining. And so I think people are realizing the scarcity of gold, where there isn't any sort of scarcity value in fiat currencies, or for that matter, in the cryptocurrencies.
Can you repeat that statement? You said that the above ground amount of gold is only in 4 Olympic swimming pools. Is that what you said?
Yeah, 200,000 metric tons. You could fit that. It sounds like a lot, but it really isn't. You can fit that into 4 Olympic-sized swimming pools. So it's tiny.
Wow.
And 4,000 tons is even a fraction of a pool in terms of what we're mining as an industry every year. But that's coming down because reserves are down 40% over the last 7 years. And we're starting to see evidence of that decline in reserves in our production profiles as an industry. So production is coming down from that 4,000 tons. So again, given the barriers of entry, getting into the mining business, the difficulty and the lead times and the capital intensity to bring new mine supply on pace, it's very, very difficult for us as an industry to respond to the rise in gold price that we've seen over the last several years.
Now, one of the questions that's kind of always fascinated me is around the subject of the not getting the true price of gold and silver. And you're someone that's been in the industry forever, so you've seen. So, I mean, you were involved in the biggest merger ever. I mean, you as of just as much of anybody has seen the ins and outs of this industry. And it's very interesting to me because we know from the WikiLeaks that the U.S. cable about price manipulation. We know it, and then we've seen these companies or these banks get in trouble for spoofing. We know that there's a vested interest in whether it's psychologically making people stay away from it or using actual short-term uh, price manipulation. But one of the things that's always interested in me is all that does is keep the average everyday person away. That doesn't keep Russia away, it doesn't keep China away, it doesn't keep central banks away, it doesn't keep multi-billionaires away. They're buying during this time. Has that ever felt just a little odd to you? Because it almost seems like the big money recognizes that and it becomes a buying opportunity then. And we're kind of seems like maybe we're just coming out of that phase. I'd love for you to kind of speak on that and the true value.
Yeah, look, the big driver of the gold price, in my view, is demand. And there have never been more ways for us to physically buy gold than we have today. You know, we have the ETF, which we didn't have 20 years ago. So the average investor can buy the physical commodity, and they can invest alongside the big institutional investors like the central banks, or for that matter, high net worth individuals who can afford to store their gold and buy the physical gold. But now there's a way for the average investor to physically participate in the gold market. And what the equities provide, you know, the gold equities that producers provide is leverage to that gold price over and above just the movements up and down the gold price, because there's leverage in the profitability. Their margins expand much more dramatically on a percentage basis than gold price increases would indicate. So you get that leverage proposition. You also get leverage to exploration and buying the gold equities. But also, you know, the other way to play this, and I think it's the best way to play this, is through the royalty companies, because royalty companies provide that leverage to the gold price like the physical ETF does. It provides leverage to the exploration success of our partners that run these operations. So as they grow their reserves, the royalty companies participate in that upside. But what we insulate our shareholders from is inflation and capital operating costs, because our exposure is entirely to the top line. We get a percentage of the revenue. So as the gold price goes up, our revenue goes up. But we don't have any of the capital costs and operating cost inflation that the operators have to deal with. And I have to tell you, given that we're at incentive pricing for both gold and base metal development, copper prices are all-time highs right now. We are going to see significant cost inflation again in the mining industry. And so as an investor, you have to protect yourself against that. And yes, you can buy the GLD and you won't have that exposure, but unfortunately with the GLD, you don't get that exploration upside. You're really going to get that through the royalty players. And that's why I think gold royalty is a very, very good investment, a good vehicle to participate alongside the sheiks and the central banks that are buying the physical gold, and do that without having to pay storage costs and deal with operating capital cost inflation.
How do you think right now stacks up to previous times in history where you've seen tremendous moves in mining stocks? Obviously, you've been a part of that. How does right now stack up versus previous experiences?
Look, I think we're at the leading edge right now. I don't think we're anywhere close to the all-time highs in terms of multiples to the gold price. I think it's been much more cautious. I think what's undermined gold equity performance, which hasn't been bad, but I would think what's undermined it is the fact that their assets are shrinking. As I said, reserves are down 40%. So the value of their business is shrinking, all other things being equal, because reserves are really ultimately the indication of the underlying value of the business. That the reserves are shrinking and the value of their business is shrinking. So they've done a great job of harvesting returns and paying dividends and buying back stock and deleveraging. The industry has net zero debt, first time in its history that we've been in that position. So business has never been in better financial shape, but from a reserve and resource standpoint, it's in very, very poor shape and cannot participate meaningfully in the upside in the markets. And that's why royalty companies are an important part of really turning around that dynamic. As companies refine their mine building skills or exploration skills, royalty companies provide a meaningful source of capital to finance that exploration and development.
So give us an idea of what's going on at Gold Royalty Corp. You and I spoke, it was a while ago when we spoke. And so give us an update and let us know what's going on.
Well, when we last spoke, it was prior to our IPO. We were just in the process of launching that. And that's been very, very successful. We raised $90 million US back in March. We started trading on the NYSE American under the symbol GROY. And that 90 million US was 3 times what we targeted to raise in that initial public offering.
Oh, wow.
So we're going out with an offering of 30 million US, but the order book came in at close to 140 million US.
Nice.
So many multiples oversubscribed. And so we upsized the book. And that's put us in a significant competitive advantage relative to our peers in the sub $1 billion market cap category. We came out with a post-money valuation of just over $200 million US. The stock has held in well. It's given us currency and it's given us cash on the balance sheet to diversify beyond the 18 royalties we started with, many of them with our partner Gold Mining, our parent company that owns 48%. So we're going to put that $90 million to work in double-digit rate of return royalty opportunities. We're going to diversify that portfolio, grow it, create critical mass. And I also think there's scope for consolidation among that sub $1 billion category. There's been a proliferation of these royalty companies, many of them poorly capitalized. They don't have the cash that we do have on the balance sheet, nor do they have the management depth. Within our board management, we have collectively over 250 years of operating experience, of running and building mines and mining companies. Many of the other royalty companies are really just run by financial engineers who have no operating experience whatsoever. So we bring a unique perspective and we bring significant capitalization to the table.
How much of a sense of urgency do you feel to get deals done now while the price of gold is still, well below where many of us feel it should be? I mean, it's only 1860 still. So how much urgency do you feel to get deals done right now, where we feel we're nowhere near where the price of gold and silver will go?
Well, all good management teams always operate with a sense of urgency. To deploy capital, to grow value, and any shareholder would want their management to operate with a sense of urgency. That being said, we're targeting double-digit rates of return in any royalty opportunity that we buy, whether we're doing that through acquiring an existing royalty, an existing operation, or putting capital to work in new development stage opportunities, and funding the development and exploration of promising opportunities on the gold and silver side. So we're going to be disciplined about how we allocate capital. We are operating with a sense of urgency, and there's no lack of opportunity out there, given the existential imperative for the industry to invest back in exploration and development. We're seeing a lot of opportunities, and we think we'll be able to creatively allocate capital for our shareholders and create value.
What do you think is a result of now, for so long, governments and media, it seems like they not only hid inflation, they essentially ostracize you if you pointed out that infinite quantitative easing was bad. And, now you're even seeing, of course, as I said, someone like Warren Buffett come around and, you see it. I mean, I saw a picture in Virginia of $7 a gallon gas. I was back in California recently visiting families. $5. I live in Utah, so we've got real cheap gas out here. I mean, but it's went up a lot too. And back in California, it was double the price. You're seeing this and you go, you know, they can't raise rates, right? They can't. I mean, I guess they could, but it would be apocalyptic in nature if they did. And so you look at it and you go, does this just go infinite towards inflation until they essentially peg currencies again with something? What happens when masses of people, which they already are, but they begin in mass to realize their salary that they get the same amount every 2 weeks buys them 20-30% less? What is the result of this, do you feel, and where do you feel that it goes?
Well, it's not that we have to go far back in history to see the effects of that. If you go to pre-World War II Germany or post-World War One, the Weimar Republic, to see what could happen when there's a lack of confidence in fiat currencies. It's recent history, and history tends to repeat itself. And clearly, you're right. There is no scope for central banks to raise interest rates because the amount of debt strapped on by sovereign nations globally, particularly during the pandemic crisis, is unprecedented. There's no conceivable way for them to pay that debt back. They have to inflate their way out of debt. In other words, undermine the very currency they're issuing debt in. They have to do that in order to reduce the amount of debt to a sustainable level. But that undermines the confidence in the fiat currency and results in massive inflation. And once we get into that inflation cycle, and we experience it, I said post-World War Germany, but we also experienced it in the 1970s in North America when we had hyperinflation then that was triggered by the oil crisis. So, we don't have to go far back in history to see what the results of this type of hyperinflation can do to undermining confidence in the economy and in fiat currencies.
And obviously, this is the environment. There's probably many iterations of people finally waking up to the consequences of this money printing, and each one foreseeably might give a next jolt in the gold price, a next jolt in the silver price, as more and more people say, "Man, can't do this anymore." And that's the same thing. Obviously, there's a lot of speculation in smaller cryptos as you go on, but it's sparked out of the same thing where it seems in mass people are starting to go, this currency isn't so good no more. And so then the question is, does it go until it can't go anymore? Or do they do they have to peg the system to something once inflation gets bad enough? What is your personal opinion on how this looks in the future?
Yeah, you're right. There's going to have to be a new foundation established for a reemergence of fiat currencies. It's going to have to be pegged to something that provides confidence to the users of that currency that that there's actually some intrinsic value. Whether that means we go back to a gold standard or not, it's very hard to predict at this point. But there's going to have to be some gesture towards reestablishing the credibility of these fiat currencies, and people are starting to realize that these currencies have the scope for infinite supply. Right now it's just limited by whether the printing press breaks down or not. There's an infinite supply of fiat currencies, whereas in the case of gold, there's a very, very finite quantity of gold available on the Earth's surface. And as I said, it's very, very difficult to introduce new supply into the market. There's incredible elasticity of supply to price on the gold side. We can't respond quickly enough to increases of price.
Now, do you think then that that is the devaluation of currency is a primary reason to own gold? And then you say, well, this is going to bring the price of gold higher. And then you say, well, if you want leverage to it, this is where you enter into mining stocks. Is that the mindset behind it?
Yeah, absolutely. I mean, first you have to buy into the thesis as an asset class, an investment class. And if you do, and I see no reason why you wouldn't, given the undermining of fiat currencies going on and gold's role as the one true currency for 4,000 years. And then really it's a matter of how do you play it? How do you best maximize your exposure to that and maximize the protection the safeguarding of your capital you're looking for? And again, I would argue that the best place to do that is in the royalty space, and that's why I positioned myself at this point in my career. After over 30 years in the operating side of the business, I think this is the best place to be positioned to participate in the upside in the gold price.
Yet that's interesting because you kind of answered a question that I have, which is, you've been so successful at this. I mean, why go into, first of all, why do another company? And second of all, why in the royalty space as opposed to, senior management at a company that's, one of the biggest in the world? Why?
Well, look, I think the operating companies are going to need, and the development stage companies are going to need the royalty players now, just given the downward dynamic we've seen in resources and reserves and production.
Due to fill that supply
Yeah,
deficit that we're seeing?
exactly. I'm positioning myself at the value creation end of the spectrum in the development exploration side, where I think most of the value has to be created to sustain the industry. I think there's going to be an avalanche of capital coming from the mining business into exploration and development, given the existential imperative of replacing reserves and production. It's become so acute right now. That's where I think the capital has to go. And the industry is well positioned to do that now because they have no debt. They have good free cash flow. We're at incentive pricing for new gold development and exploration. So they have to, and they're economically motivated to put capital work in exploration and development and an area that's the area they've starved of capital for 6 or 7 years as the industry focused on free cash flow and deleveraging and paying back dividends and share buybacks. I get all that. I think they did a great job of that. Now they're going to have to overcompensate and focus on the development and exploration end of the spectrum. And that's why I'm positioning myself there at this stage in my career.
Yeah, very interesting. It's like you hear somebody say that, but it's another to hear someone that's kind of at the top of the mining industry, and you say, you open the door and you realize there's not much storage left in the closet, right? And then that's what's made you shift to this, Gold Royalty Corp and focusing on royalties. Now, let me ask you. I like to always ask people when I have someone like you on that's become so successful. And right now, there's an incredible amount of people that either are really struggling financially or they just realize they need to make more money because their cost of living is going up. And you're someone that's excelled at everything that you've done in the mining industry. Give me an idea of some of the most important success principles that have aided your business success and your financial success that you think are important for us.
Well, look, I think with anything, when you're allocating your own personal capital, you want to ensure that you're getting outsized returns that one safeguard your capital, but also generate a return well above what the real inflation level is in the economy. And I would argue that we're in kind of double-digit inflation territory. We're
Wow.
seeing our currency being significantly undermined, and leaving it in a bank account that's generating a 0% interest rate, and in fact, seeing your capital erode because of that inflation while it's just sitting there is just not the way to go. You need to find ways to protect your capital and generate strong rates of return. And I'd argue in the gold space, the royalty companies provide that protection, but also provide outsized returns. One, because we can access capital much more cheaply than the established producers do. And we allocate the capital, and Gold Royalty in particular is allocating the capital, expecting to get double-digit real returns on our invested capital. And that's the kind of protection you need in this type of inflationary environment where your fiat currencies are being depreciated every single day while it's sitting in your bank accounts earning nothing.
Where now we've had a lot of time to kind of digest um, gold price consolidation, starting to get a move back up, and more importantly, because maybe there's short-term emotions that move the price of gold, but we understand the long-term trajectory is really moved by global government and central bank monetary policy, and it's very clear what they're going to do. As you said, they're going to inflate the debt away. And so my question to you is, where do you think the price of gold can end up? And when do you think this inflationary cycle will end?
Yeah. So to me, the ultimate, I'm not saying the ultimate, but I think the next milestone for gold is achieving all-time cyclical highs, which we're not even close to yet. If you go back to 1981 when gold was $850 an ounce, in 2021 dollars, that would be over $3,000 an ounce. So we haven't even achieved our cyclical peaks. And we did achieve a nominal peak last year when gold was over $2,000 an ounce, but that's still not the all-time high on a real dollar basis. So that to me is the next significant milestone. But I think that's almost a down payment on what this cycle could ultimately deliver for the gold price. Because the last time we achieved those cyclical highs back in 81, we had hyperinflation. We didn't have nearly the quantitative easing that we're experiencing right now. And certainly it wasn't coordinated as it is now. Back then, central banks didn't talk to each other. They almost competed with each other back in the 70s and 80s. Since the credit crisis a dozen years ago, they coordinate their efforts. They compete to debase their currencies to preserve their export markets. So they're acutely aware of what the others are doing, and they're doing it hand in glove, all of them. And so that's what's unprecedented about what we're experiencing right now, and how prolonged it's been, how coordinated it is. And that's why I think the $3,000 is just the start.
Yeah, it's like George Carlin once said, it's a big club and you ain't in it. So then my next question to you is just coming back over, first of all, before we talk just a little bit about your goals moving forward with Gold Royalty Corp, I want to ask you, tell us a little bit more. I mean, you were the CEO of a company that sold for $62 billion. I mean, like my wife's like, who are you interviewing today? I was like, remember that guy, David, that I talked to, and he sold the biggest gold company in history. And, it's a pretty cool stuff, but give us an idea of the trials, the challenges, getting going in the industry to become, one of the most successful executives at it. When were some difficult times, maybe during bear markets, and how did you get out of them? What were important things you relied on?
Yeah, look, I actually, most of my career I spent with gold well below $1,000 an ounce. When I started in the gold business, gold was $250 an ounce, and kind of was range trading for forever. It started to break out in the early part of this century, but not in any significant fashion for 8 or 10 years until we got through the credit crisis. And then we started to see a significant appreciation in the gold price. And I think the biggest challenge in the industry is not finding capital, it's finding ounces in the ground. That's very, very difficult to do. And you have to be systematic about drilling and building. You have to do it through the highs and the lows in the sector. And there are very few mining companies that actually consistently do that. And I was very fortunate in working with Inmet Mining on the base metal side, Agnico Eagle for 12 years as CFO, and then spent 5-6 years running Hudbay Minerals on the base metal side, and back to Gold Corp for the last several years before I launched Gold Royalty. And each of those companies had strong technical foundations and systematically drilled and built through the ups and downs of the cycle. That's why a lot of those businesses sustain themselves and continue to sustain themselves today, because they've been consistent about allocating capital in the ground to find new ounces, because they have always recognized that we run depleting businesses. Every day that we pull an ounce out of the ground, we're dying a little bit unless we're reinvesting a bit of that profitability back into exploration to replace those depleting reserves and resources. So the challenges I've always found has been finding that next deposit and then putting it into productive use, because the lead times are long, the capital intensity is high, the barriers to entry are high. Those are where the most significant challenges are, is in finding and then ultimately building out those ounces into productive mines.
How do you keep screwing your head back on if you said the price isn't moving? I would imagine there's many, executives or people that wanted to be executives that, gave it a shot. And after a very frustrating time where the price isn't moving at all, how do you screw your head on when things aren't the way you're imagining them in your head? Obviously, this is a situation where when many people don't see the results that they want, or the movement they're expecting, eventually they talk themselves out of it and move on. How did you not do that?
Well, you have to have a mindset that you can't realize instant gratification in an industry that typically requires 10 to 20-year lead times to bring new mines into production. You have to just recognize that it's going to take a long time. You have to have strong stakeholder support, and that takes years and years to build out. You have to have a good geological model, and that requires a lot of drilling and technical work to get to that point. And you require a lot of capital investment. But ultimately, you have to believe in the economic cycle. We are in the natural resource business in a very cyclical sector. And so you have to recognize that over time, those cycles will come to your favor. They require time, but the economic fundamentals ultimately deliver those cycles. And so what you're trying to do is find deposits that are long in life, and it's very difficult to time them to hit the peak of the cycle. But if you put a mine into productive use even at the bottom of the cycle, and you've got 10 to 20 years ahead of you in terms of reserves, you're likely to realize 3 or 4 cycles over that 10 to 20-year period that will give you outsized returns for the capital you're investing in the ground. So it requires patience. It requires patience in terms of your mindset, but also in terms of the capital you put into the ground. You need backers that have that sort of patient outlook. And so you have to be quite selective in terms of selecting your sources of capital.
Not getting instant gratification in a business that sometimes takes 10 to 20 years. That's quite a callous, and that's why you become so successful at it. That's amazing. That's an amazing quote. Now, you were talking about cycles. What inning of this cycle do you think we are in? If it was a 9 inning ball game,
I'd say top of the second. Home team's pitching. It's top of the second. We've got a long way to go. This is undoing what the central banks are doing right now will take a long, long time, and the gold price will benefit from that.
Yeah. So, give us an idea of goals moving forward with Gold Royalty Corp. We're at May 17th, 2021. As you said, when we spoke, you were just releasing, you were just getting ready, getting warmed up, and now you've had a great move, a lot of successes. So give us an idea of what's coming down the pipeline.
Yeah, I expect we'll be quite prolific in our acquisitions of new royalty opportunities and growing and diversifying our royalty base beyond the 18 royalties we currently own. So I'd say stay tuned. There'll be deals announced. We've been very, very busy looking at new opportunities, and we will be adding quite systematically and regularly to our portfolio, because at the end of the day, a royalty company is kind of like a bank. We're taking funds from our shareholders, almost like deposits, and we're putting that capital to work, lending it out, if you will, out to producers and developers, and taking back payments as royalties over time. But with the upside kicker of exploration success and the leverage that provides, and leverage to the gold price, obviously, as that goes up. So we'll be very active in that regard. I also think there's lots of scope for consolidation in that sub $1 billion category in the royalty space. There's been a proliferation of new royalty companies that have come into the sector over the last couple of years. There's too many of them. And I, given the depth of our board with over 250 years of mine operating experience, I think we're well positioned with that and the capital we have on the balance sheet and the access to the capital to be a consolidator in the sector. This is a very, very experienced team. And I think we will have the backing we need in the capital markets to be a consolidator of the more junior royalty players in the space. There's just too many of them, and we need to create critical mass quickly, in my view.
Makes a lot of sense. So how about silver? Name of the company's Gold Royalty Corp, right? But what about silver, right? It's attractive, of course, due to the green energy movement, the renewable movement that is in the early stages. I always think that basically we're going to get to a point where the government, maybe even people sour off stimulus, so they're going to reframe it all into infrastructure, and they're just going to pump so much of it into renewables. Silver seems to benefit from all of that. So how about silver?
Look, I'm a big believer in silver as, if nothing else, a proxy for gold. And I think in a rising gold price environment, silver has the potential to actually significantly outperform gold. And it's simple arithmetic. In a bull market, typically the gold to silver price ratio is 40 to 1. Today, it's more like 70 or 80 to 1. And so that ratio will narrow. And that means the silver price is going to have to outperform gold. So a lot of people that are going to look for a way to play the precious metal space will look at silver at $25 to $30 an ounce and say, hey, actually, I can buy more silver ounces than I can gold ounces. That's my way to play the precious metal rally. And silver price has the potential to significantly outperform, fundamentals aside, demand supply fundamentals aside. That's just how the cycles have played out in the past. And that's how I see silver performing going forward as gold goes up.
Awesome. So in conclusion, give us an idea of what you feel are, you have 8 kids, right? So you're looking at the world right now, and the most important things for people to be successful, to get ahead, to create their own freedom. What are you teaching your 8 kids, or what's most important that you want to leave with them?
Yeah, protect your capital. You know, uh, you know, well, one, build up intellectual capital. All my kids have been in university or going through university, and I think that's extremely important. That intellectual capital is important. Nobody can ever take that away from you once you have it. That's what I've taught all my kids, and my wife Christy and I. But also, yeah, as they've gone in the world workforce and started to create income, uh, find ways to preserve your capital. You know, diversify your portfolio, start to build a portfolio, but also start to diversify it and buy the assets that are scarce. Whether it's gold, whether it's real estate. They're not making any more real estate anymore. It is what it is. So make sure that you're in things that have uh, a hard element to it. Um, Intrinsic value. Something that's sustainable, and create value that way. Buy the things that are scarce. Don't put your faith in things that are not scarce. And I'd say fiat currency is the opposite of scarce. It's infinite in its potential increases in supply, and not have confidence in those fiat currencies. Try to protect your capital.
So for everyone listening that wants to check out Gold Royalty Corp, where can we find you, David?
So GoRoyalty.com, and we're GROY on the New York Stock Exchange.
Awesome. So for everyone listening, give us your gold price predictions in the comments right there down below. I'm liking to see this move here. I think we're in the early stages of a pretty interesting end to the year. Maybe we'll see a similar type of timeline and scheduling to the seasons that we saw with gold price in 2020. So give us your gold price predictions in the comments right there down below. Make sure you hit the like button on this video on either side to send this out into the YouTube universe so more people see this video. And David, you got to give us, I know you're focused on being an executive, but you got to give us your gold price predictions for 2021.
Oh, I'd say we're going to see 3,000 by the end of this year.
Awesome. So everyone, give us your comments right there down below. We want to thank you for coming on, David, and I'm looking forward to talking soon. Congratulations on such an amazing move all the way to the New York Stock Exchange so quickly, and keep up the good work.
Thanks, Jake.